Okay, let's set the scene. I want you to picture it. The year is 1999. The air is electric. The internet is exploding. Every company is adding a .com to its name, and the stock market feels less like an investment vehicle and more like a rocket ship that only goes up. In the middle of all this chaos, this euphoria, old school investing, well, it looked completely dead, and its biggest champion, Warren Buffett, looked like the biggest fool on Wall Street.
And this slide right here tells you exactly why. In a single year, while the tech-heavy NASDAQ just went ballistic, soaring an incredible 86%, Buffett's company, Berkshire Hathaway, actually lost 20% of its value. I mean, the difference was just so brutal, so massive, it really felt like we were watching a changing of the guard. The old master had finally lost his touch. The public pressure on him was just immense. Barron's, one of the biggest financial magazines out there, put him on the cover with that exact headline. "What's wrong, Warren?" Everyone was openly wondering if his way of doing things was just obsolete. He was being painted as this stubborn old guy who just didn't get the new economy.
Now here's where it gets really interesting. In his annual letter to shareholders, Buffett himself came out and said his performance was terrible. He gave himself a D. But, and this is the key, this wasn't an apology letter. Oh no, it was a defiant, deeply logical masterclass that would go down as one of his most important writings ever. It didn't just predict the crash that was coming, it laid bare the entire philosophy of the Berkshire Empire. So that's what we're going to do today. We're going to tear down that very letter. We'll start with how he saw the big picture of the bubble. Then we'll uncover the secret engine of his empire, something called insurance float. After that, we'll look through his special lens for valuing a company. And we'll wrap up with how these lessons from history can be an antidote for all the market madness we see today. All right, first up, let's talk about how Buffett saw the market from like a 30,000-foot view. While everybody else was chasing individual tech stocks, he was looking at a fundamental economic problem that, frankly, should have been terrifying. So you might be asking, why didn't he just buy the tech stocks? I mean, was he just being stubborn? Nope, not at all. It all came down to one of his core ideas, his circle of competence. See, for Buffett, understanding a business isn't about knowing how its gadgets work. It's about being able to confidently predict its earnings 10, 20 years from now. With all those .com companies in 1999, he just couldn't do it. So for him, buying them wasn't investing. It was pure speculation. And this right here is how he knew the whole market was in a bubble. His logic was so simple, it was brilliant. The US economy, the GDP, was growing at about 5% a year. Now think about it. Over the long run, it's just impossible for all corporate profits, as a group, to grow way, way faster than the economy they're part of. But investors were pricing stocks like they were going to grow 15, 20% a year forever. That giant gap between reality and expectation, that, my friends, is a bubble. So, Buffett made the tough choice to just sit out the party. But you don't build an empire just by playing defense. See, Berkshire had this machine that was constantly churning out capital for him to invest. And that machine is his insurance business. But the way he thinks about it is totally different from anyone else. The key to the whole thing is this idea he calls the float. So think about it. You pay your insurance premiums today, right? But you might not actually file a claim for months, or maybe even years. That giant pool of money that the insurance company gets to hold in the meantime, that's the float. It's basically a giant loan from all the policyholders that Buffett gets to invest for Berkshire's own profit. But here's the secret sauce. Not all float is good float. If an insurance company is disciplined and prices its policies correctly, then the premiums it collects will cover all the claims it pays out. That makes the float a zero-cost loan. It's an incredible asset. But if a company gets greedy and starts selling policies too cheaply just to grow, its claims will be way bigger than its premiums. That float then becomes a toxic, high-interest loan, a huge liability. Buffett has famously said he'd rather shrink his business than take on toxic float. Okay, so Buffett uses this massive, zero-cost loan to buy pieces of great companies. But when he's looking at those companies, he uses this special lens, almost like X-ray vision, that lets him see value that standard accounting just completely misses. He calls this lens look-through earnings. Now, normal accounting says your income from a stock is just the cash dividend you get in your account. Buffett says that's just nonsense. He argues that you also own a piece of the profits the company keeps and reinvest back into the business. That money is still yours. It's just being put to work for you by the company's management. And this example from 1999 makes it crystal clear. Let's say Coca-Cola earned $100. It paid out $65 in dividends and kept $35 to grow the business. An accountant would say Berkshire, which owned 8.1% of Coke, only earned $5.3 from those dividends. But Buffett's look-through view says his real share of the total earnings was actually $8.1. That extra $2.08, that's hidden value, totally invisible on a normal income statement, but very, very real to him.
So what about all those earnings? Well, in 1999, everyone was screaming at Buffett to buy back Berkshire's own underperforming stock. But he laid out this incredibly strict three-part test. He said a buyback only makes sense if all three of these things are true. And that last one is the killer. The stock has to be trading for way less than it's actually worth. Buying back an overvalued stock, he said, is just stealing from your loyal long-term shareholders to overpay the ones who are leaving.
So Buffett stuck to his guns. He stayed in his circle of competence, he used his disciplined float as fuel, and he invested based on true look-through earnings. So how'd that work out for him? Well, just like his logic predicted, the bubble didn't just pop, it exploded. In 2000, the high-flying tech stocks just collapsed, wiping out fortunes almost overnight. The very people who had been laughing at Buffett just months earlier were absolutely ruined. Meanwhile, his discipline, the very thing that earned him a D in 1999, protected his shareholders from all of that carnage. In the letter, Buffett used this fantastic song lyric that just perfectly captured the moment. When a market goes crazy, people will give you 1,000 reasons why this time is different. But as the quote says, trying to come up with a logical reason for insanity is a fool's game. True wisdom is knowing when to just stay away. And this brings us to the most important question. This isn't just a fun history lesson. We live in a world of constant hype, constant noise, and there's always a new bubble forming somewhere. So how can we take Buffett's clear-headed thinking and apply it to our own decisions today? Well, one of the most powerful tools is based on the exact same macro logic he used back in 1999. It's a simple ratio that compares the total value of the entire stock market to the size of the whole economy, the GDP. This metric, which people now call the Buffett Indicator, gives you a really quick read on whether the market is cheap, fair, or dangerously expensive, just like it was in 1999. And what's great is that you can actually track this for yourself. To make it super easy, just go to the Apple App Store and search for the Buffett Indicator iOS app. You can download it and get daily updates. It's really a modern tool for applying this timeless piece of wisdom. Of course, just a quick reminder, all the analysis in this explainer is for educational purposes only. It is definitely not investment advice. Please always do your own research before making any investment decisions. And by the way, if you thought this was interesting and want to hear our deeper dives, you're welcome to join our Deep Value Club membership. And don't forget to subscribe to us on Apple or Spotify podcasts at Deep Value Investing. Thanks so much for watching.